The decline in value of the Indian rupee as against the US dollar, sliding to a record low of 80 to a dollar this month, has raised alarm over its implications for the Indian economy in some sections, but there's also a nonchalance in the other. At one extreme are misplaced comparisons to the economic crisis in Sri Lanka. On the other, there's an attempt to brush it aside as a matter of only a little concern due to the robustness of India's economic fundamentals. But what really is the situation? This decline in the rupee's value against the dollar has been largely attributed to the ongoing Russian invasion of Ukraine, due to which there's been a significant rise in the price of crude oil. The dollar has been a beneficiary of this because it's a standard currency for oil imports for many countries, though the Russian ruble has also gained in value because Russia has insisted that payments be made for its energy exports in its currency.
I don't think that we should be alarmed. I feel the war will come to an end. Already the prices of commodities are weakening. And what I don't think Reserve Bank should be doing much more. In fact, I would rather that they conserved the foreign exchange of the Reserve Bank and not do these market operations. They have done a few positive things, and that's fine. But let me come back to making my point that a smart country undervalues the currency slightly. And the reason is that it helps exports. You know, India, recent years, exports have increased, and that's a wonderful thing. But by and large, India has been a failure as the kind of exporter it should be for our size of the country. I mean, India's exports are 2%, around 2% of world exports. And that, for a country with 15-17% of the world's population, that's a failure. And also, if we don't succeed in exports, we won't create the kind of jobs that we need to create as a country. And so our priority should be jobs, our priority should be exports, and hence, I would say, and remember also that no country became a rich or a middle-class country without exports. So in that scenario, I wouldn't worry very much. Yes, high currency does hurt imports, it does hurt, and the cause of our cause, I mean, hurts people as well. Prices go up, etc. But I think this is a short-lived phenomena. Oil prices will come down to reasonable levels, and therefore, I would suggest that let's focus on our priority, which is exports. And frankly, the cause of the rise of the rupee is not just the Ukraine war. It is the interest rates in the US have resulted in a massive outflow of foreign portfolio investment money.
At a fundamental level, since most of our external trade is dealt in the dollar, our imports are likely to grow more expensive, while our exports would become more competitive as they'd be cheaper. But India, which is heavily reliant on oil and natural gas imports for its energy security, is a net importer. For instance, in June 2021, the overall value of our imports was $52.93 billion for the month, and the corresponding number for our exports was $52.79 billion. This June, the imports are valued at US dollars 82.42 billion and exports at US dollars 64.91 billion, a net cost therefore of more than US dollars 17 billion. June and July this year have been particularly hard on the value of the rupee against the dollar. If one takes the numbers from April to June this year, the figures are more pronounced, with a negative trade balance of 45.18 billion US dollars compared to a negative trade balance of 5.61 billion US dollars in the same period last year. Export and services and information technology is one of our prime revenue drivers and are likely to benefit in the short run due to the strengthening of the dollar against the rupee, as most of these transactions are also undertaken using the American currency. The pharmaceutical sector, another prized asset, will also gain, though the cost of their imported raw materials will rise. Textile exports are also likely to receive a fillip, but there's also much to worry about. We import almost 85% of our oil and natural gas requirement, and that will hugely impact our balance of payments due to the increase in the value of the dollar against the rupee. Moreover, the reliance on imports for solar cells may impact tariffs and costs of solar panels even as we try to make a shift to renewable energy. The input costs for many FMCG products are high because of imports of crude and palm oil, so that will hit consumers hard, as will the increase in the price of electronic items, including phones, as yet again there's a strong import component involved here. Travel overseas will become more expensive, as will flight tickets, which have already escalated in recent months due to the rise in oil prices. So while we aren't facing an economic crisis, there's a lot by way of costs that will surely hurt consumers. But here's why an alarmist reaction is not called for, according to several experts. India's currency is not isolated when it comes to losing value against the dollar. India has weakened against the dollar less than the Japanese yen or the British pound or the euro or the Korean won over the last 7 months. So this is an issue that is clearly global in scope and significantly influenced by what's happening in Ukraine. The Japanese yen has fallen 19% in value over 7 months against the dollar, the British pound more than 13%, the rupee's decline stands around 6.6%, and the Chinese yuan at a relatively less 5.7%.
The thing is, it's not the fact that the rupee has weakened, the dollar has strengthened. That's the first mistake people make. And against the basket of currencies with which we trade, Indian rupee has in fact remained stable or even mild, appreciated against some. So it's not a cause for alarm, and we should not regard a strong rupee as a sign of national pride, as a sign of that a strong currency is not necessarily a good thing. A currency should be competitive, and sometimes it's even better to have a weak rupee in order to help our exports. If we continue as a successful nation, we may have the highest economic growth rate in the next year and in the years to come, and hence I would suggest that we should relax and focus on what we are doing, and the long term with exports, rupee will become stronger. And above all, Reserve Bank must stand up to political pressures to keep the rupee strong.
But if one goes a bit further back in time, over a period of 2.5 years since the onset of the COVID-19 pandemic, the fall of the rupee against the dollar has been more pronounced. This, according to reports, is an outcome also of a growing trade deficit and foreign institutional investors taking money out of India. So the rupee has been subject to a period of prolonged depreciation and weakness, a fall in value from 71.26 against the dollar in January 2020 to 79.38 in July, about 11.4%. Though still better than the Brazilian real at 29.6% and the Japanese yen at 25.9%. And if one takes a 5-year benchmark, the rupee has actually depreciated 23.2% from 64.45 to a dollar to 79.38. Only the Brazilian real has experienced a greater fall of more than 67%.
If you are visiting, let's say, US, one of my colleagues went there, and he was telling me cost of gasoline in the US market, it is around $5, which never happened, and so which again translate to 500 rupees per liter. Now, why I say that India in that way is much better, because as you can see, the price of petrol is much less compared to what we see in the context of the European Union or in the US market. And we are also seeing what is happening with our neighbor, in particular Sri Lanka and Pakistan. So going by all this idea, I think Indian government has done quite well in terms of taming the instability, or let's say when we are talking about fiscal deficit, let's say when we are talking about the price of petrol and diesel, or when we are talking about the price of food items, I think we are in a much better shape.
The reason why many are not willing to react with alarm is because India's external debt, while still high, is very much in control in terms of its proportion to the country's overall GDP. If one goes back to 1991, when we were compelled to undertake economic reforms because our foreign exchange reserves were only adequate to sustain 2 weeks of imports, our external debt had peaked to 28.3% of our GDP. Our foreign exchange reserves at the time were just enough to service 7% of this external debt. That number now is 97.8% in 2022, though it must be said that there's been a depreciation in the value of our foreign exchange reserves over time as well. But there's also a cause for concern. As Nilanjan Banik writes in the Times of India, the competitiveness of our exports is also dependent on the incomes of those countries purchasing them. After all, as he writes, the real GDP growth in the euro area is expected to slide from 5.4% in 2021 to 2.3% in 2022. He also says that China's own GDP growth rate is projected to fall from 8.1% in 2021 to 5% in 2022. While the United States is experiencing inflation to the tune of 9%. The US Federal Reserve has reacted strongly by raising interest rates, resulting in many global investor funds switching to the US financial markets, eyeing greater growth.
If you are selling something to the outside world, two things matter. One is the foreign demand, which is also functional upon foreign income, because if your income is less, of course, you are going to demand less amount of import. And the other factor is how competitive is your export items are. So in both this count, India is actually suffering. Why? Because we see kind of the economic growth has slowed down, be it European Union. The economic growth has fallen from 5.3% to now less than 2.3%. For China, India is another largest trading partner. The economic growth has fallen from 8.1 to now they are saying less than 5%. For the US, for the first 2 quarters of this calendar year, you will find they are suggesting an economic growth of only 1.3%. What I mean by economic growth is the growth in GDP. So most of our exports are actually income elastic, meaning that they depend more upon the income of the foreign trading partners compared to the price elastic, So because if you see which are our major exports, these are like refined petroleum product, these are like some pharmaceutical product, these are like engineering goods, these are like precious metals like and stones, like diamonds, and so these are the items we depend upon foreign income. Now, because the foreign incomes are actually coming down, we see our export is not growing. The other part is what I said, that our export are also not competitive when it comes to the price sensitive item. For instance, leather food. I'll give you a very specific example. When it comes to trade in pharmaceutical product, we call it intra-industry trade. What does it mean? It means that you are trading in similar commodity. You are exporting and importing the same commodity. But when India is exporting active pharmaceutical ingredients to, let's say, China, the value of our export is much less compared to when we are importing the same item from China. Now, why is that? Because in terms of quality, we are not able to compete with Vietnam, Bangladesh, China, and other countries. And this is also particularly true with respect to textile and apparel products. So because of this, we are actually losing on two counts. Foreign income is falling. That has reduced the demand for our income elastic export. Also, in terms of quality, we are not able to compete with some of our major competitors like Bangladesh, Vietnam, and China.
And Banik also estimates that the rupee could fall further. Now, how much is too much? That really could decide the extent to which we can withstand this depreciation.
Now, the value of rupee is determined in what we call in terms of floating exchange rate. Now, because the relative supply of dollar has fallen vis-a-vis rupee, it is not surprising to see why the value of rupee is depreciating. In fact, what I wrote in the TOI article, I think it is the rupee is going to settle around 83 mark per dollar within the next 6 months. And the reason why I say so, you will find that recently the government has also increased the GST, on packaged food item. Now that has some implication on the inflation rate. So although the June numbers, it has come down a little bit, but it is going forward in the next quarter. I expect the inflation rate to go up a little bit on account of GST being implemented. And also, there is also a feedback effect in the sense that as the value of your rupee start depreciating, the value of your import, in this case, we are talking about crude and coal, that value of import is going to become much more costlier.
There will be sustained pressure on India's current account deficit because of the rising import bill. So what really can be done to address the situation? Should India dip into its forex reserves, which we've done to some extent, but won't that then impair the financial wherewithal of commercial banks as well as money supply?
The Indian rupee is holding up well relative to both advanced and EME peers. The recovery is gradually strengthening. The current account deficit is modest. Inflation is stabilizing. The financial sector is well capitalized and sound. The external debt to GDP ratio is declining. The foreign exchange reserves are adequate. In recognition of the fact that there is a genuine shortfall of supply of forex in the market relative to the demand, the Reserve Bank has been supplying US dollars to the market to ensure that there is adequate forex liquidity.
For the time being, the RBI's priority has been to address inflation, and it has raised the repo rate on 2 occasions. Inflation has been over 7% since May and well over the threshold of 6%, which is the RBI's own tolerance limit. But again, as per reports, India's inflation rate is 108th in terms of rank among 172 countries. Others are in a far worse situation than we are.
See, in terms of the exchange rate, trying to control the value of exchange rate, more than the government, it's what RBI is doing the firefighting. Because they are the one who can intervene in the foreign exchange market. Intervene means you can buy and sell dollar, depending upon whether you want to arrest the falling value of rupee. The problem is the RBI is also doing what we call contractionary monetary policy. They are increasing the rate, trying to stave off the inflation numbers. Now, the problem is this inflation is happening not because of increase in demand. This is happening because of lack of supply. From the government perspective, I thought maybe one good idea is to bring the petrol and diesel under GST.
Having said that, the consumer here continues to feel the pinch, and there's been a massive political face-off during the ongoing parliament session over price rise, the depreciating rupee, and the rationalization of GST rates. The debate on the state of our economy is only likely to intensify.
Well, I think to talk about a threshold, I mean, the so-called 80 was the magic figure, and I don't think we should worry. It's not going to go crazy as in Sri Lanka and Pakistan and so on. It's not. We are a strong economy. Our fundamentals are strong. In the current year, we are going to be the fastest growing major economy in the world. And so we should not worry, relax, relax about the currency and focus on our priorities as a country, which is to create jobs.